All right, folks, welcome back to the Monday Fibonacci sessions. We have modified the Monday topics. Mainly, of course, Fibonacci is still on Fibonacci's, but how to manage your trades using the Fibonacci ratios, different kinds of Fibonacci ratios. Bottom line has always been, which I always try to put across to everybody, is that you must have a trade plan. And a trade plan simply means that you must define your entry, exits, and stops before you enter the trade. First and foremost, of course, that you have to define your technical setups, that this is the technical strategy that I'm going to follow. If this happens, I'm going to take the trade. If this does not happen, I am not going to take any trades. Unfortunately, most of the traders think that technical analysis or chart reading or taking a position as per the charts is about it, right? If you go to my website, I have always preached about what is the 3Ms. This is my website where I often offers a lot of services upon. The 3Ms, it is your money, mind, and method, or rather in the holy trinity of trading is what I call it. Now, if we were to distribute a trading plan on a scale of 1:10, your money management, that is your money, accounts for about 5 parts out of 10. The mind, psychology of trading, accounts for 3 parts out of 10, and technical analysis only 2 parts out of 10, which tells you that for a trading plan to be successful, to be effective, you have to take into consideration your money management and your mind factors more than technical analysis. Now, unfortunately, most of the traders think that it's only technical analysis, and what happens is that we decide our trades based on chart reading. That, okay, this looks good and we are going to take a trade based on this. So you concentrate more on technical analysis, on charts, on taking positions, and within that also, again, unfortunately, most of the traders look at indicators. Believe me, indicators are lagging. Price always gives you the best possible clues. We use the Fibonacci's with precise effect or with absolute precise levels to determine a trade. Now, do fibs really work all the time? Well, they may not. Nothing works 100% in trading. But you have to use the tools of technical analysis in such a way. It enables you to manage your trades, which is the topic for our Monday Fibonacci's. Use the part of your technical analysis so that you can manage your trades correctly. That is more important. Finally, it is your money management, your trade management, your risk management, which is going to ensure success. It is not technical analysis. Let's start with the Fibonacci's. We will go over harmonic patterns. Let's start with the basic concepts of a regular divergence. This is on the gold daily. We had a regular divergence. This is a bullish regular divergence. It simply says that once price gives you a low and a lower low, your stochastics give you a low and a higher low. This tells you that this move down has gone down with reducing momentum, and one would expect a change of trend. Now, a divergence does not necessarily mean a change of trend. There are times when divergence forms, consolidates, and still continues down. So you need to define your entries, that only if this happens, if your momentum has turned bullish, I take an entry or I do not. Now, divergence can be identified on any oscillator kind of an indicator, your MACD, your RSI, your CCI, your momentum, but we use the stochastics because the stochastics have got certain characteristics, which again comes down to the point that use the indicator to its best effect. So once we have identified the divergence, now let's see, how do we trade it? Do I just simply jump into a long? We know that price has given me a low, lower low. The stochastic has not confirmed that. So we are looking at a loss of momentum. We are looking at a shift of momentum. Do I immediately jump into a long? No. There are rules and conditions. First of all, you identify what your targets are. We have defined the points of the divergence. Your first low is your D1. Your second lower low is your D3. And the highest high in between the 2 points is classified as your D2. What you do is you plot your fibs from D2 to D3. A fib projection will give you an expected target. So one part, your target is defined. Your stops always to be placed beneath D3. So your stop is defined. What does your entry say? For entries, you can keep it very, very straight to break of trend lines. You can just plot your trend lines and you can enter on the break of a trend line. Let's say you're keeping it very, very straight and simple, and you enter on the first bar which closes above the trend line. Right? So you have this bar which has closed above the trend line. You enter on the open of the next bar. This is where your entry is going to be. So entry into the trade on the open of this bar, stops to be placed beneath D3, not exactly at D3, beneath D3, expected targets D2 to D3, Fib projection 127, 161. Your expected targets are 127 or 161. Usually 127 is a likely target. Now before I have entered the trade, before I do enter the trade, my entry, my stop and my targets are completely defined. What does this enable me to do? This enables me to plan my trades. Now price has not yet reached the 127, it's just about consolidating, but if I'm in a trade, I would still remain long because I know 127 is a likely target. How do you manage a trade? The topic which we have today is manage your trades based on your Fib levels. Well, your entry, let's say you enter at 920.30, you take profits. For any kind of a trading situation, you can never predict the outcome of a trade. Even if price is going in your favor, a trader should be wise enough to take profits off the table for the simple reason that price may go anywhere tomorrow. It could just reverse just as suddenly, and you don't want your winning trades to turn into losing trades. So we keep certain levels. For me, a 78.6 is often I consider it to be as a barrier. I will keep my 78.6 as a mid profit taking level. As we can see, price did pause for some time at the 78.6. So as soon as we enter the trade, price reaches the 78.6, we manage the trades. We take some profits. The money management rules say that the minimum number of lots that you should enter a trade should be about 3 lots. You should never enter with 1 lot. If you're entering with 1 lot, it does not enable you to maneuver around your money management rules, and you're putting yourself at a disadvantage even before you start. As it is, trading is a very, very difficult profession. You need to put the odds in your favor. Until and unless you do not look at these aspects, you have failed at the gate even before, let's say what they say, that the horses go off the gate, you have failed right at the beginning. If I can put these kind of, or my experience over here, and tell you that these are the factors that you need to concentrate upon, believe me, it will save you a lot of grief. And this is a fact. It's a been there, done that kind of a situation. So let's assume that we have entered this trade with 3 lots. I'm going over the management because how do you manage your trades? When price reaches 78.6, you close 1 lot and you shift your stops to your break-even level. At this stage, you are in what we call as a free trade. For whatever reason, 78.6, if price decides to reverse, if it reverses down, you have walked away from the trade with this much of profit and no risk. Your stop is at your break-even level. So you have walked away from the trade, which as a trader, your ultimate aim is to make money. Right? We are not here just to have fun. We are not here to gamble. We are here to make money. As a trader, you must take your profits off the table and minimize your risk as far as possible. And we use the tools of technical analysis to enable us to do that. So once we know that 78.6 is a barrier level, we take profits over there, because if your pattern has to fail, it would normally be at your 78.6 level, so we take profits. We have already taken profits, price broke through it. Now we wait for price to reach 127. It's almost at 127. We close off your second lot when price reaches 127. And again, if you want, you shift your stop to a little below your 78.6 level. You are locking in more of profits. Let the third lot run in case price decides to go up to 161. If it does not, well, okay, so you close off your third lot even somewhere over here. But what you have done is you have managed your trade, which is more important. You know exactly when to enter, you know where your exits are, you know where your stop is, you know your trailing stop positions. So the fibs, the Fibonacci ratios, are to be used as levels or steps, if you may call, for your trailing stops to lock in profits. I never use the fibs in the sense, okay, if price stops at 61.8, I'm going to go long over here. Now that is a foolish way of using any kind of technical analysis. It's always a question of if then. If price does this, this is what I'm going to do. Do not predict price, follow price. Now, as I often like to say, you are not an astrologer, you are a trader. Right? So we use the tools of technical analysis because I know that if price is going to stop at 78.6, I use that as a profit-taking level. If it breaks that, then the next 127 seems to be likely. Okay, so this was one example of a divergence, using the Fibonacci's for your divergence. Let's have a look at something called the harmonic patterns, which for most of you who are familiar with the Monday Fibonacci sessions that we go over, we would like to go over this particular situation. All right, okay, we have a couple of questions. Eds, can we answer the questions after we are done with this? Since we are in a recording. Hi Amol, good to see you over here. Right, now Fibonacci's very, very effective. I have found them very, very effective. Let's talk about harmonic patterns. What is the base of your harmonic patterns? First and foremost, the first thing is when you have an impulsive wave, you simply plot your fib retracements. Once a fib retracement stops precisely at a fib level, finds support or resistance as the case may be. Now this stopped at 61.8. Maybe not precisely, this much of leeway is acceptable. If it stops precisely, it's expected to give me a harmonic pattern. The harmonics are very, very precise, and again we are using the rules of the harmonics to trade within the legs or within the waves of the harmonic pattern. A harmonic pattern is one impulsive wave which is followed by two corrective waves, which gives rise to a larger impulsive wave. So anytime you come across this situation, you know that this is what a harmonic pattern is. This is a Gartley pattern that we are talking about, very, very specific. If your B, first retracement, first corrective wave stops at 61.8, sorry, then your second corrective wave CD will stop at 78.6 of XA. XA 78.6. In this case, it went down to 88.6, which is acceptable. So once I have B stopping at 61.8, I'm waiting for price to rebound from there. If price does not take out the previous high, then we can expect one fresh move down, which will stop at XA 78.6, and most of the times it does. That is the preciseness of the Gartley patterns. Plus it is at a confluence, XA 78.6, BC 127 or 161. In this case, it stopped precisely at 161. So how does one manage these trades? You have an impulsive wave. First corrective wave stopping precisely at a fib level. You have a possible harmonic pattern, Once price stops at a fib level, does not exceed the high of A, and it is at a fib level. C will be at a fib level of AB. It stopped at the 50% of AB. I can trade the wave CD for the simple reason that I know my CD wave is a combination or confluence of XA 78.6, BC 127 or 161. I can confidently trade this because the fibs are very, very effective. So I take short trades right down to this level. If price finds support over here, I can trade the larger impulsive wave. Now it may not work all the time. As I've often said, in trading, nothing really works 100% of the time. But believe me, the kind of success or the kind of ratios that we get with the harmonic patterns are almost to the tune of about 70 to 80%. So out of every 10 trades, 7 to 8 trades work out correct, which is phenomenal odds for a trader. Believe me, coming down to another topic, a win-loss ratio of 50%, that means out of every 10 trades, if you have 5 trades correct, you're considered to be a good trader. And if you have patterns like these, which are very, very effective, and which you can trade within the legs of the pattern, within the waves of the pattern, because you know precisely where price is going to go. Right, let me show you some situations on these and how they have worked. A harmonic pattern, you have identified this is a bullish cartlay. Your targets are always plot your fibs from A to D, 127, 161. In this case, price did go up. On a daily time frame we are talking about. AD 127, 161. Price went way above the 161 also. But we would have managed the trade, taken profits at some stages in between so that we are never at a loss. Right? This was a classical textbook example. We have an ongoing example on the AUD JPY. Okay, Mima, I'll go over this one. How do I scan or choose for pairs to trades? Let me go over a couple of situations so that you get a better idea about management. See, my concentration or the theme of this topic or today's webinar of this session is not the fact that your harmonics really should work all the time. It's the fact that harmonics have got specific rules. A divergence has got specific rules. Once you come across that, you should manage your trades based on this. Let's go over the AUD JPY on a daily time frame. Your first retracement stopped at 61.8, right? Exactly at 61.8. So we were expecting the second retracement to stop again at 78.6. When did it confirm? When price bounced up from here, stopped at a fib level. This was at a fib level. It did not take out the high of A. So we could trade the wave CD down confidently because the wave CD is your XA 78.6 or 88 as the case may be, and BC 127, 161. There you go. Price stopped precisely at the junction or at the confluence of these two trades. So we take a short trade and we close the trades over here because we know the price is not going to go further than this. It has found support. Successful trade. Now price has bounced up from here. What are the expected targets of this harmonic pattern? Fibs AD 127, 161. We have set a target of 127. We've been following up this trade since the last couple of weeks. In the process, price has given some pullbacks. We are on a daily time frame. 1 or 2 days of pullback, which is expected. But because you know the thumb rules, you are going to remain in the trade. The first profit taking level over here, actually in this case the first profit taking level was earlier at about the 50%. The second profit taking level, if you may, is at the 78.6. Price is almost over there. Once price reaches here, which is also a previous swing high, becomes an effective level of resistance. Swing high, resistance, resistance. So we can expect some pauses over here. We close some profits and our stops were originally over here. We shift our stops. Now price may not go to the 127. It may just reverse from here. As traders, we have to be prepared for that. Something may happen tomorrow. For all you know, your yen pairs are weakening, right? Your AUD JPY is going up, so your yen pairs are weakening. Something happens, maybe some fundamental reason. The Bank of Japan announces sudden increase in rate, and this pair will suddenly tank. Can you control the markets? You cannot. Can you control the fundamentals? You cannot. As a trader, you are here to take profits. Price respects these levels. Price reaches this level, take your profits. Shift your stop up to a trailing stop, lock in your profits. If it goes further, your money management rules will enable you to remain in the trade. If it does not, if it reverses from here, you have taken profits. You have walked away from the trade with some profits. And believe me, even a profit of 10 points in your account is much, much better than a loss. To recover from a loss, you have to make twice the amount of profits. Always try and minimize your risk as far as possible. So again, we are managing the trades based on these concepts of the harmonics. Right? GBP USD, sterling pound, we are looking at a possible butterfly pattern. We were looking at Gartleys. I wanted to show this to you. A butterfly pattern on a daily time frame. Price gave a retracement, stopped exactly at your 78.6. A butterfly says if my first corrective wave is at 78.6, second corrective wave is 127. Now we are looking at a trade. We are currently looking short for price to find support. For all I know, as traders, what are the alternatives available to us? Don't you think we can say that this is a bearish 1, 2, 3 pattern? This is 1, this is 2, this is 3. Price could continue further. But the possibility of this move is very strong. So we take trades, we take shots based on we are waiting for a break of the trend line. We take shots if price finds support over here. We close off our short trades and look for longs because we know where the targets are. If price breaks this support, then it will fulfill the pattern of your 1, 2, 3, and we know where that target is. Again, am I predicting price? Am I saying that price is definitely going to go down and stop over here? No. If it breaks this trend line, we go short till this level. If it finds support, good enough. We know where this target is. If it breaks, we know where this target is. We follow price. We do not predict price. Let me show you one situation which did not work out, which is not working out. Euro CAD on a daily time frame. First retracement precisely to 61.8, and we had strong resistance on almost like a double top. We were expecting price to find support somewhere over here to give us a harmonic pattern. Tended to go short, remain short, price broke through this. We are almost at a double bottom. So this is not a harmonic pattern. So the harmonic pattern has been negated. Doesn't matter. What matters is that we took a shot, a bounce from this level. Even if we would have closed off our trades over here, expecting price to go up, we did manage to catch this shot. Based on the thumb rules that price is expected to go down, ideally you should still remain in the trade, follow the price with some kind of trailing stops. Alright? No, Amol. If price stops between a fib level, it's not valid. The thumb rule of your harmonic pattern or any Fibonacci related pattern is that if price stops precisely, close to precisely, little bit is acceptable here and there, at a fib level, then it is acceptable. If it does not, then it is not acceptable. Then you don't have a pattern. We will go over that, Amal. Stop loss and margin size. Margin size, I cannot discuss it with you for the simple reason is margin depends entirely on your money management. That's a different topic altogether. Stop loss, yes. On any harmonic pattern, on this one, if I'm going short, my stop is going to be placed above the high, above this particular high, where it found resistance at the 78.6. Right, let's come down to a situation that something which did not work. So how do you scan for these charts? Well, let's just take some pair somewhere. Okay, I'm sorry about this. Okay, how do you scan for trades? Generally what you do is, let's take, as I was saying, let's take one pair some way off, something which I really don't trade too much. Let's take the USD and okay. Right? It's just on a daily time frame. If I'm planning to look for harmonics away, how do I scan it? Well, what I do is whatever time frame you're following, whether it's a daily, whether it's a 4 hour, As soon as price gives you some moves currently, I would plot my fibs from the swing high, swing low to the swing high. If price stops precisely at a fib level, then I have a possible harmonic pattern. If it does not, I just discard it. I don't look at anything for that matter. Right? Let's just remove this and let me get over with this. Let's take the AUD New Zealand. Let's see if we can determine a possible harmonic pattern. Now this is way too much. What about the Euro CAD? Did we have a harmonic from this swing high to this swing low? Well, in this case, one can say, oh, this is the same one that we looked at. I'm sorry. I'm getting confused over here. There, I drag my symbol onto here so that it gives me the chart. Nothing really looking very good. CAD JPY. CAD JPY, we again were looking at a harmonic pattern, waiting for price to stop at a 78.6. It did not. If it crosses 78.6, the barrier, it tells me that the momentum is still bullish. As I've said, 78.6 is an important barrier level. Then I would expect price to go up to 127. Right? So this is what I generally look for. Now, I look at it on the daily time frame. I look at it on larger term time frames. Let's say you are an intraday trader. Let's say you are trading on a 15-minute time frame. You can do a very, very similar thing. It really doesn't take much time. Right? Swing low to swing high. Did it stop precisely at a fib level? It did not. So I do not have a pattern. Right, Amol, now this comes down to specifically that there has to be a precise fib support level area. All right, AB, we'll just have a quick look at that. Cable 15-minute. All right. Cable 15-minute, right? A Gartley 15-minute chart. When would point B actually be formed? All right, okay, this looks like a Gartley. Now this becomes a good example as a live example. So the expected trade that we are looking at is, this is your Gartley. If it's at 61.8, your second corrective wave is to 78.6. Now C has to form at a fib level. So based on AB, let's just zoom this inside. Your C could form at a fib level, which could form at 61.8, which could form even at 78.6. The condition is that C should not take out the high of A. If it takes out the high of A, this one, then your pattern gets negated. If it stops anywhere over here, probability of price giving you this move down to a 78.6 is very, very high. So that is a rule of your harmonics. This is how one can really trade the harmonics. If price finds resistance, possibility. So as a trader, what do? Your alternative, you wait for resistance. If it finds resistance, you are going to trade this. Your trade to this one, you know where your target is, you know where your entry is, you know where your stops is. That becomes important. That's how one must really use it. New Zealand JPY M30. Yes, Amol, if it goes beyond 78.6, then it's really not valid. Galuska, you had a question on New Zealand JPY M30 Gartley. Okay, let's have a look at that one. New Zealand JPY 30 minutes. Right? This is the one we were talking about. 13 minutes. New ID, I'll come down to this. So, Galuska, which one would you be looking at? Would you be looking at this one? So price expected to 78.6. Is this the one? Yes, Phantom. Yes, it is. I was just going to say that it is a bearish Gartley which has been completed. The first one was 61.8. Your second one is expected to stop at 78.6, close to 78.6. Let's check the fibs. Right? Your C point, as I said, your condition for C is that it should not take out the low of A. It stopped at 88.6, which is acceptable. D forms at a confluence. Let's check this confluence. It is 127, right? So your D, reversal level D, is XA78.6, where we plotted the triangle. It is also BC 127. So this is a bearish Gartley which is completed. You would expect moves to the downside if price finds resistance at 62.65. We don't know. Patterns are known to fail. Your expected moves to the downside is going to be 127, 161. So your thumb rule, if price finds resistance, your stops are going to be placed above that. We are assuming that price will stop. Your entry into the trade, for the time being, let's keep it over here. The simplest thumb rule to enter into a trade, let me give you a secret of the harmonics. A harmonic is a 5-wave pattern, right? Your B point is a central point of the pattern, which becomes an effective area of support resistance. Plot a horizontal line along the high of B for a bearish Gartley. This becomes your entry. So if price finds resistance over here, you are going to enter on the break of 62.44. Stops to be placed above 62.62. Expected target 61.60. Again, manage your trades. Use a 78.6 in between. Once price reaches here, manage your trades. Right, let me come down to on one new ID's question. Entering one lot at a fib level. See, new ID, what happens based on money management? Everybody's got a different approach. What you would do if you are entering one lot each, let's assume that this is a live situation we are looking at. If price finds resistance over here and we have expected go down, right? Price breaks this, you enter one lot. Once price goes in your favor, you enter on a second lot. What you're doing, one thing is you're pyramiding your positions and you are increasing the distance between your stop and your entries. This is your second entry. Remember, never play around with the stops. If my original stop is over here, if I'm going to enter second lot over here, I will not place my stops close by. Your stops have to be at your technical level. If I'm increasing the distance of my stops, that means I am increasing my risk. That as a trader is not acceptable to me, right? So everybody's different situation. If you'd like to play a second impulsive move after D, yes, AB, I suppose that would be. Well, all right, folks, I think this was about it. I think this will shut down.